Boom, and we're live.
Yes,
I
we
think,
are.
right?
I think so. We're going to have to ask for some feedback from our folks from Fonoa who are on the call to tell us in the chat. Hopefully, can you hear us okay? Can you see us okay?
See if
Okay.
it works or not.
Folks already know how to use the emojis. I love it. Let's just
Awesome.
check that
I'm
ours
still
are
trying to
working.
figure out how I can centralize you guys on my camera, but that will be something for a later moment, I guess. Aiko, do we have everyone? Because I can't actually see you guys. I don't know why.
Oh,
Can you see if we have everyone?
well, we've got 14 people that have joined us so far. We can give it one more minute, so 2 minutes past, and then we can start off with at least the basic admin. But until
Yeah,
then,
sounds good.
let's
And I
get let's
think
give
we're
it
going to
one.
do the intros anyway, so people
Yes.
don't have to wait for that, I guess. So shall we give them one more minute and then kick it off?
Yeah, one more minute, folks. Let's just usually, as you know, this day and age, people are on a Zoom call or a team meeting or something like that, and by the time they switch across, just gives a 1 or 2 minutes comfort break, and then we can definitely kick it off.
Awesome. Great.
But
Meanwhile, I'll try to figure out how I can brighten up my camera. I don't know what I'm doing wrong.
you are definitely in one of the chill dark. I don't know what it is. It looks like a nice place. It's a very nice camera, Rob.
Yeah, but it doesn't bright up somehow. I'm doing something wrong.
Give me a second. I'm going to put you
Next
on the
time.
spot. Actually, let me just see so we can actually. There you go.
Yeah. See, it's weird. I don't know what I'm doing wrong. I'm trying to figure it out, but
Not
next
working.
time.
Next time.
No,
We get it.
no.
But the microphone's working.
Is it awesome? That's also the first time. Okay. Right. Yeah, I think we're 2 minutes in. Let's kick it off if you're okay with that.
Yeah, absolutely.
So, welcome everyone to today's Fonoa Tax Essentials. It's a new one, solving SaaS challenges, tax challenges specifically. It's September 7, if I'm not mistaken, and we're going to talk about everything related to the tax complexities of a SaaS business model and broader the industry. Today we have a great team in front of you. We have Alexander Aiko, known to me, who is our head of tax technology and also the former head of tax technology at Uber. We have David Pevich. Do I say it right, David, from a pronunciation perspective?
That's close.
Awesome. David is our solutions engineer for today. He is a guru on everything technical side and tax technology, so he can help us later on in this webinar as well. And then, of course, to introduce myself, I'm Rob. For those of you that don't know me, I'm the Chief Tax Officer here at Fonoa, and I was the former head of international tax at Uber as well, hence why I know Aiko for a little bit longer. Today, we want to basically start by highlighting some of the complexities that are specific to the SaaS business or business model or industry, if you will, that then, of course, flow into the tax complexities. So we can highlight some of these common complexities that we see and how to approach them. But before we do, Aiko, maybe it's good to share some of your knowledge on the household side of things when it comes to this platform. I'm not so technical, as you know, so that's always something that you can help me with if you don't mind.
Cool. I could take over that part. Hi, everyone. Once
Thank you.
again, great to see some familiar faces coming back and also some new people dialing in as well. For those of you who have never used this platform before, Livestorm platform, you can respond, react. It's designed for engagement, essentially. We love your questions coming in. At the bottom of your screen, you'll see a couple of buttons there. There's the chat button. There is Ask Questions button. If you want to engage, if you want to provide a view or an opinion on something that we're saying, especially if you want to disagree, please do. We love a challenge here and a bit more of a debate. Please do engage with us. And at the very least, you have an emoji react button. Just let me know that everything is working for you by going and hitting one of those emojis, picking something, thumbs up, shock face, party. And yeah, there we go. Perfect.
It works.
It works. Awesome. And that's about it. Apart from that,
where can people ask questions and everything? Is it also there?
Yes. So let me show you. There's a chat that we can have for everyone. So chat is.
I was about to say there are two options, right? You can ask private or public.
Yes, you can ask privately or publicly. If you ask, I think if it's the question is sent through the questions buttons at the bottom, that will only go to us from what I recall.
Got it. Okay. Let's do it. I think we can dive straight in from my perspective. So if we go to the next slide, when we think about the SaaS business model, through a tax lens or broader from a business model perspective, we have identified what we think are the 6 main characteristics that make this such a complex model. Eiko, can you maybe highlight some of these?
Yeah, so it's almost like a game of snakes
I
and
was about
ladders.
to say, creative icons.
Maybe something we say for those of you who've been to our webinars in the past, we you know the format is a little bit more casual and relaxed. For those of you who are new to this, we do like to have a little bit more fun throughout the webinars. So forgive us for that, but I'm sure you'll get used to it as we go. So we are presenting in the characteristics in the slide of symbols. The very top one is, what are the characteristics we are observing of SaaS businesses, and specifically tax teams within SaaS businesses? Usually your teams are quite lean within those businesses. Typically 1 or 2 indirect tax individuals, and the second going down, those individuals are usually based within one particular jurisdiction, or let's say a handful of hubs, typically either East or West Coast of the United States, a person in Europe, potentially somebody in APAC, and somebody in LATAM if you're lucky in that sense. So it's not a very heavy team when you come and compare that to, let's say, more traditional types of businesses, which have got a lot more people on the ground within the jurisdictions that they operate. Which comes us to the next point. Just this little globe icon means what we're saying is that a lot of these companies are global from day one, that they're, until let's say very, very recent, there's literally not that many borders or barriers in the way to entry into specific markets for them to be able to sell your your services, your digital products. And as a result, a lot of these companies become global from day one. As a result of that, their transactions, if they're successful in their volumes, they scale very, very quickly, very, very rapidly globally. The next symbol essentially represents a bit of healthy budget pressure that is within those companies. Rob, I know you've taught me in the past on what this actually means from a non-tax perspective, but perhaps you can enlighten it once again. I don't mind. Sorry to put you on the spot. Do you mind just talking through why there's healthy budget pressure in these companies?
Well, what we see, at least when we talk to these companies, and of course also in our own experiences, that when we're talking about SaaS business, we're assuming that you're a fast-growing digital model where you probably have been looking for external funding at some point in your journey, and that then typically comes from VCs, or from venture capital and or private equity. And those type of investors, of course, have certain expectations when it comes to your return on investment on their investment, and that means basically that you not only need to grow fast, because that's the expectation from a revenue perspective, but that you also need to maintain certain profit margins. And that then, of course, follows that you also have to be very careful on the cost control side. So maintaining a margin by having that centralized team, like you mentioned, that's typically more lean and thus more cost efficient, combined with fast growth and a global reach, that is what defines the SaaS model, I would say, and why it's so interesting from an investor's perspective as well.
And I guess leading on from that, as a result of investors plus the optimism and the culture within the companies, is that they typically have very high ambitions, like very, very big ambitions.
Conquer the world.
Yep, exactly. You want to conquer the world. So
exactly. Yeah.
I mean, this all together, this essentially brings a big challenge across over to the tax teams within the companies.
Yeah, maybe just to summarize this. So what you're saying is, like, you have either one or a few individuals centralized fully, typically, or at least regionally, but mostly in one place, that are global from day one, have a lot of countries that they potentially are selling into as their markets. Oh, something happened on my end. And then you have to deal with limited budget and major ambitions, right? That's kind of like what defines the SaaS model and what we believe causes certain tax complexity, right? And then if you go to the next slide and look at what that ordinarily feels when we talk to these teams from a tax perspective, is a little bit like this. It feels like you're carrying the world on your shoulders, in the sense of having a lot of responsibility with very limited resources, way too much to do, and you have to figure it out, and you have to navigate that complexity almost by yourself, right?
Yeah, exactly.
So the main question that we then often, of course, get when we're talking to mostly broader finance teams is like, who cares and what can go wrong, right? Well, what is it really that can go wrong here? And Eiko, you came up with this beautiful model on
Well,
screen?
wait,
Maybe
hold
walk us
on.
through it.
Let me
We came up
hold on.
with
Let
it.
me defend myself before you throw me under this.
Let me not throw you under
So,
the bus.
yeah, hold on.
I was
I
part
came
of
up
it.
with
You're
a
right.
very sophisticated model, which was literally an x-axis with two things on the side. But we've now over-engineered this slide to make it look.
It looks fancy. You're right.
It actually looks. It's not supposed to look this fancy, folks. It was supposed to look.
It's very simple,
deliberately.
right? It's a
very
spectrum.
simple.
That's
Yeah.
basically what it is, a spectrum.
It's a spectrum
Go
from
on.
going for where you want to land in the middle. On the one hand side, on the left hand side, you've got doing what you shouldn't be doing. What do I mean by that? By doing not what you shouldn't be doing, you're potentially not registering. Doing what you shouldn't be doing, you're potentially charging taxes in places where you shouldn't be charging taxes, or on those transactions that you have identified as non-taxable. You're still charging the taxes because it's simpler for either your tax engines or your systems. And also on the other side, not doing what you should be doing in that sense. Exactly the opposite of that, not registering locally as a SaaS business, not registering for those cross-border transactions. We typically, why is it a two-point axis? Why are there two parts in the scale? That is the easiest thing that we see from companies when they grow. From the prior slide, as they grow fast, they have to make one of two choices. Either going to be ultra conservative, registering everywhere and charging taxes, which is typically not what I observe, but it's rare, but it does happen. The more common scenario is that folks don't register, they don't apply the taxes, and they wait until something happens for them to action that, which is understandable given where the history and the context that is. A lot of the companies that scale so quickly that the first indirect tax person who genuinely wants to look into this is a much later hire than the rest of the business, and they have to then come back and clean a lot of this stuff up. So where you want to be ideally, I mean, the sweet spot is you want to be doing what you should be doing at the right time, in the right place.
And what we're saying here is that nuanced approach is not always what we see in practice. Instead, we actually see companies taking one of these two far ends of the spectrum and taking a more binary approach, right? Which clearly is not the best.
It's the easiest thing to do, right? And it depends on the culture within company. Exactly.
Yeah, not the most accurate, let me put it that way. You're right.
Okay. But the next question is, Rob, who really cares?
That is the question, right? Because why wouldn't you do that if you're understaffed? Well, what we see is that specifically in the SaaS business model, a lot of people tend to care, including tax authorities, of course, but also the business or commercial teams, and of course then the legal context that follows with that as well. What do we mean here? Very simple. If you look at the impact of this, of either charging too much or too little, is that it basically has a direct impact on your business, in the sense that if you sell remotely, it could potentially mean that you're pricing yourself out of a market if you're selling with VAT where it shouldn't be due, or GST for that matter, any indirect tax, and vice versa. If you don't collect any indirect taxes at point of sale, you typically end up down the road having to pay for it anyway, and then it comes out of your existing margin because you didn't collect. So either way, it's going to impact the business. That's why we typically see businesses care about this a lot. Then on the legal side, perhaps even more scary, what we see is that it actually happens that businesses are being shut down for not being compliant with local indirect tax rules, even if they're selling remotely and they're ordinarily not in reach of local government. Due to all of these rules changes, that actually happens. They block you, basically, or they name and shame you, or other things. Of course, you also see that there's a latent liability that's being built up that ordinarily follows you. So you either have to deal with the penalties, late interest, audits that come at some point in time, or, and that's also important, I think, to mention, is if you have a savvy financial auditor, you will have to explain yourself anyhow and potentially provision for these latent liabilities at a point in time. So from that perspective, even if you're not doing what you should be doing, it show up on your balance sheet and through your P&L. So I think that's probably relevant to mention. And that then, of course, if we're again talking about high growth and we're talking about potentially going public, so IPO, filing your S1, and or being acquired, for example, the due diligence that comes with these processes tend to make it hard not to be compliant as well. All to say, people do care about this, sometimes directly from a business perspective, sometimes somewhere down the road, but it's probably something that requires our attention.
I think just a maybe very quick aside for 10 seconds, Rob.
Yeah.
You mentioned the triggering points for when people start to care. You said there's an IPO, the listing, so filing the S1, and then there's also the M&A transactions being acquired. personal experience there is that you do see a lot of the tax risks and exposures becoming certainly a talking point during those events.
100%.
So they do definitely come up and they
It's
matter.
crucial. Yeah, exactly. And then you have to have your story ready. So maybe we can take a look at, like, because now we're talking very high level, right? Like high level, what should you do? High level, what can you do? Let's take a closer look at some of the actual tax challenges that we see on a daily basis, and that some of you may recognize or not, and then probably want to recognize going forward. What we see, generally speaking, by the way, is that in this model, because of the centralized nature and the cross-border sales nature of the model, is that most of the complexity sits in the AR space. So the accounts receivable or the actual sales transactions side of things, and not so much in the accounts payable or AP space, simply put, because it's a centralized model. But having that said, that of course does justify its own attention, but we're just not going to touch upon that today.
So what you're saying, we're going to focus on accounts receivable rather than accounts payable.
Accounts receivable, yeah, the actual sales transactions from a SaaS model perspective. So, and if you then look at it, we look at it at least oftentimes from a transactional lifecycle perspective. So what happens to a given sales transaction? And you can then basically split it up in pre-sales, post-sales, right? Those are the two facets that you want to look at. Pre-sale, in this case, probably three, but two main questions at least pop up in my head that you want to be able to answer from the get-go. And one of them is like, who am I actually selling to? Is this a B2C or B2B transaction? And oftentimes in practice, companies, both small and large, are not really equipped to do this properly, in the sense of assessing whether you are dealing with a consumer or a registered business, tax registered, that is business, that is purchasing as a B. And that's something that's crucial, of course, because of the potential cross-border consequences that often come with that. Simultaneously, and this is another one that is, I think, often overlooked still, you want to know where your buyer is actually based. And even though that sounds quite logical, in today's age where you buy over the internet, you have different factors that can point into different directions. What we see is that sometimes you have in this case, Eiko, I think you're in the UK right now. You would have an IP address showing up, right, as the UK. Well, you're probably these days registered somewhere else from a residency perspective, and that will be your main address. But maybe, perhaps, given that you come originally from the Netherlands, you would use a Dutch card from a payment perspective, right? So you would have three different indicators that point to a different direction, and you want to be able to point to a single direction for determining the place of supply, because that influences, in many cases, of course, the outcome. So all to say is you need to be able to understand the rules in each and every jurisdiction when it comes to determining whether this is actually qualifying as a sale into that jurisdiction. And you also want to be able to understand whether you're dealing with a business or a consumer prior to actually making your tax calculation. And that's, of course, that vertical line, right? That's the point of sale. At that point in time, you do need to determine whether or not you're calculating taxes, and if so, how to calculate them. We see that one of the major aspects here that, again, often goes wrong is that if you want to do this in a nuanced way, you have to do it at lightning speed, because the consumer these days that's transacting over the internet doesn't have a lot of time and tends to drop off if it takes too long. So you want to make sure that this is fast.
Yeah,
right?
You don't want to see the spinning wheel of
exactly. Yes.
the
yes,
spinning wheel
exactly.
of churn. Let's put it that way.
Yes, exactly, or not refreshed results there.
Mhm.
So then you actually have your sale, assumingly taking place. Then what, Eiko? What happens on the post sale side from your perspective?
From my perspective, three things. The first one is, well, you crystallize the transaction that you calculated from a tax perspective. You then need to document it, typically, which is, if it's a B2B transaction, in some cases, you need to generate the proper documents, provide your consumer or customer, in that sense, with the right invoice or receipt if it's a B2C. In some jurisdictions nowadays, in a growing number of jurisdictions, you don't only document in, let's say, the traditional paper form or PDF electronic form, but you also need to report those transactions to the government. So many of you are already familiar with examples of, say, like Taiwan or Serbia in this case, where you might need to report the transactions in real or near real time to the authorities. And of course, there is the last element is not only the collection, but also the remittance of the monies back to the authorities, which, believe it or not, still these days can be a bit of a pain. Why? Because some countries around the world, they do require you to have local bank accounts. That's shrinking, but those instances do exist. Then there's another one, which is kind of a hidden one. I know that you and I have talked about this in the past, Rob, but it's to do with registrations.
Yeah.
that,
The question, of course, is that a pre-sale or post-sale activity? Mostly post-sale, because in many countries you can first sell and then you have to register after a certain threshold, of course. I think what's interesting to point out here are a few things. It's hard because the thresholds regulations are different for different countries. And although for large companies, of course, assuming that you have some volume, you'll go over them.
Can you give some examples of the different? Can you give some?
Sure.
Because I find this interesting. I didn't know this.
There are three elements to it, right?
Space.
So the first is, what is the threshold? Is there a threshold? And if so, is it transactional based or, for example, revenue based? So that's like what is the actual, and do you look at like local country revenue or perhaps aggregated global revenue, which some countries do as well, weirdly enough. So that's one. Then two is like, okay, but now how do you determine timing? Because it's not always calendar years. Sometimes it's rolling 12, right? For example, so from the moment you make your sale, 12 months towards the future, or last 12 months, or whatever timing kind of differences you may have there. And then finally, that's all nice and well, but if you have a local currency thresholds applicable and you sell in a different currency, then how do you convert that? And do you then do that per transaction in real time, or how are you going to handle that? It's a very nitty-gritty, perhaps, issue. But given that, and of course, again, many large companies go over these thresholds rapidly anyway, but given that you do need to register yourself at some point in time, and not everyone wants to do that from day one, you do need to keep this into mind, I guess. Especially given that some of these countries have long registration periods, right? It can easily take up to 8 weeks in some countries before you get your VAT number or GST number issued, right?
Sometimes longer.
Exactly. Yeah. I don't know these days, but yeah, it depends on the jurisdiction. So I think it's relevant to just mention, and it depends on where you are in your life cycle, how large or how small you are, but it's good to mention, I guess. So now that we've talked about these things, I think it's interesting to understand, like, what are the options? How can you solve this, right? How can you approach solving these challenges in real life? And I think there are only a handful of solutions that we see in practice. One of them is the ostrich technique, as I call it, or hope and pray, right? And that is basically, and this is again oftentimes driven by not having sufficient resources or too much work to do. Basically, is like you just don't do anything, and you'll see. You keep your fingers crossed and you hope for the best, right? Blind going into countries and seeing what will happen. We see, like I mentioned, it doesn't work. It works for a very short period of time, but tax authorities, especially in the last couple of years, are becoming increasingly more savvy, and they will catch up with you, and then of course apply penalties, late interest, etc., or potentially just shut you down, or give you negative PR, which is in a B2C context quite impactful. Alternative, Ego, I think.
I mean, here essentially you do something, but you do the absolute bare minimum. This is what I was talking about on that really complicated x-axis, saying you just take a position and say, you know what, I'm going to charge everything everywhere, taxes wherever they're applicable. The challenge there is, or the problem there is that, you'll make yourself uncompetitive in some cases. In other cases, and this is maybe going a little bit too deep, but I want to explain this, that those rules, when you're supposed to charge taxes, they change from country to country. Some require you only to charge taxes on B2C transactions. Register that. After you register, you can only continue to charge on B2C. Others, particularly specifically within the Middle East, once you register for one B2C transactions, all of your other B2B transactions also fall within the scope of that regime as well. So monitoring that, it becomes quite important who you're selling to, when you're selling. But typically what we see, you can do a bare minimum, is take a position. Either I'm going to try and register everywhere as much as possible, which is costly, or only do it in, let's say, an internal policy would come in and say, you know what, we know that this is not compliant, we'll provision for it, but what we would like to do is only register once our turnover within that particular jurisdiction hits threshold X, right? So some internal risk policies.
I agree. And this is, by the way, where your x-axis or our axis, right, of the spectrum comes in, right? Because if you really want to do this right, that sweet spot that we were showing is, of course, a moving target. It's not always the same, and you have to look at it almost at a per transaction level. And that's why taking either a fingers crossed, hope and pray, or bare minimum approach does not work, because it's too binary. So you have to solve it in a different way, I think, if you want to be accurate. And that is, of course, then through what we like, which is using and deploying tax technology. That's really the only way to do this in a sophisticated way, right? Automating it. But
Yeah,
then if you're thinking about tax automation, and this is where I think it's worthwhile to share some of your many years of experience, Eiko, on this front, is how do you choose the right software, and what do you need to look for when you're considering tax technology?
There's a couple of things. Let me just address something that Michelle Smith just posted into the chat, saying taxing authorities are using data mining to find transactions via banks in other countries. Absolutely.
Yes.
What I'll also tag on to that is not only data mining and tax, there's also even easier ways. Once one country spots it, particularly in LATAM, you're typically published onto a naughty list, which of course
Naughty
can
list,
be easy. You're published onto a naughty list, which can be read by other jurisdictions. And guess what? It's very easy for them to come back and try and check whether or not you have registered in their country. So once one country identifies you have done, the contagion effect is pretty fast. But to your question, Rob, what are the main considerations? What do I currently look for? Let me just read them out very, very quickly. So it's flexibility, performance, scalability, having an all-in-one type of solution to at least ticking as many boxes as you can. I'm looking at fast integrations, and I'm looking at coverage, not only from a country coverage perspective, but also from a business model perspective. But maybe if we've got time, should we double click on each of these, Rob?
Let's do it very quickly. I don't know how much time we have, but let's do it very quickly. I think one, by the way, that maybe to start with is the fast integration. Why? It's worthwhile mentioning. We see more and more demand for fast change and fast solutions, especially in the SaaS model. Simply put, because you expand so rapidly that your business demands a solution fast. You can't wait for a year to implement something that's more comprehensive, perhaps. So that makes it more important, I guess, to find something that you can implement quick, whilst taking like a longer term look in terms of what else you need towards the future, of course. Sorry, go on.
Yeah, no, the same. I think a lot of these are self-explanatory. I mean, flexibility really goes to the point that you want to be able to your provider to adjust to you rather than vice versa. You don't want to be shoehorned into a particular solution. Your performance, particularly in the SaaS space, if you're using, let's say, tax calculations, they have to be the latency or the speed of those calculations has to be really, really fast, because you, as you said, you don't want the wheel to be spinning and people churning in the funnel as they're about to pay for the transaction. I mean, it's really strange, but sometimes I'm guilty of it as well. If something's going too slow, I either assume that it's broken or that I'm just going to go and open up a different website. It's not any faster, but psychologically that's what happens. There's also scalability, expanding with use case and use. All in one. Again, this is coming back to the SaaS businesses today. There is not a lot of, let's say, digital reporting requirements globally for cross-border transactions yet, but if people in Europe have seen the VAT and the digital age proposals, that's certainly going to change within the coming years. It's kind of a natural evolution anyway. So once that actually happens, what even companies in SaaS will start to feel the pain of what traditional businesses multinationals have been facing, is having multiple integrations across various different countries, different SLAs, different performance capabilities, different deliverables that they can actually do for you, different capabilities within the providers. So those problems are going to start popping up in SaaS as well. Not as much today necessarily, but certainly within the future. And as I said, fast integration is always the key one. If you're not first, you're last, to quote one comedy movie. But that's it, Rob. I don't know if you've got anything else to add.
No, I think, and by the way, these are quite holistic, of course, and some of them is probably not that eye-opening and logical. But I think it is really important to take a step back and not dive into selection too early, and really think about it a little bit more longer term as well, right? In terms of what you're looking for.
Yeah, exactly. Cool. And I think with that said, we typically end our sessions, try and keep it within the 30 minutes slide, but we do like to open up for questions. However, within the last two sessions that we did, a lot of people asked us to show, put our demo, for our presentations where our mouth is, say like, okay, we're going to show you all these problems, scare the hell out of people, and then kind of like say, thank you very much, now get back to your day. That's not the case. Of course, we've got David on the call with us, who is very happy to show, maybe for the next 10 minutes to show us a little bit of the demo of how the Fonoa platform works. This is specifically to address some of the points that Rob and I raised, and to show how we've been thinking about it on our side. But yeah, happy to also field while David's presenting. If you want to put any questions in the chat, I'm happy to answer them as well. David, over to you.